So today I'll share with you a complete smart money trading plan to filter and find the best possible trades with the highest probabilities. The trading plan revolves around supply and demand areas or order blocks, whatever you want to call them, fair value gaps, liquidity runs, and one of my most reliable filters, the pivot points. If you follow this approach, you will achieve remarkably precise entries with minimal stop losses while targeting substantial rewards. So let's begin by talking about the core component of our trading plan, namely supply and demand zones or order blocks. So smart money uses algorithms to enter the market strategically at important levels, which we retail traders refer to as supply and demand. Instead of placing large amount of money all at once, they split their orders into smaller parts, forming tight consolidations on the chart. These consolidations often precede strong price movements, and this technique leaves a distinct pattern on the chart, showing where institutional money has been active. So I've researched a lot about institutional trading in the past year, and from several sources I've read that smart money trade with no protective stop losses. And at first, this seemed quite controversial to me. I might be wrong here, but from what I've learned, institutions employ a strategy called hedging, where they simultaneously buy and sell to balance their positions. You might wonder why they do this instead of using stop losses. The reason is simple. Institutions have the power to influence the market and minimize losses. Imagine they take both a short and a long position at a key level. If market momentum favors the long position, the short position faces a temporary loss, and after the long position reaches its target, price must then retrace back down to the short position's point of origin to mitigate the unrealized loss. You often hear the word mitigation in the smart money communities. Mitigation is basically the point where smart money breaks even on a losing position. Once the loss is mitigated, the price tends to align with the dominant trend's momentum. And while smart money undergo their mitigation, retail traders often get caught in analyzing double tops, flags, or various indicators that have nothing to do with why price does what it does. This allows institutional money to manipulate retail traders' positions by triggering stop hunts or fakeouts to liquidate these positions. In reality, these are actions executed by institutional algorithms as part of their predetermined strategies. Now that you understand how price is moved by the smart money between areas of interest, let me reveal the main rules of our trading plan. First, the supply or demand zone must cause a break of structure or a change of character. Also, there must be a fair value gap right after the supply or demand area. Also, a pivot point must offer additional confluence. We'll talk later about their importance. And a liquidity run must trap traders on the opposite side of your trade. This one is optional, but if you can find it, it increases the chances in your favor. So the first step is to find a high probability supply or demand area, meaning that area must cause a break of structure or a change of character. You can easily spot these zones because they appear as compact consolidation areas situated between strong and sudden price movements. You can narrow down your zone to the last candle that moved in the opposite direction just before the sudden strong movement. In this case, when there's a bullish trend and you want to make buy trades, you should pinpoint the final bearish candle before the bullish surge. If the nearby candles and wicks are small, it's better to incorporate them into the demand zone as well. So remember, this is the last area of institutional activity prior to the impulse. This is the area where a hedge position may be mitigated before continuing the bullish momentum. The same for a supply zone or a bearish order block. You mark the final bullish candle before the bearish down move. Now, very important, the supply or demand zone must be responsible for a break of structure or a change of character. These are price shifts above or below previous swing highs or lows, leading to trend changes or continuations. A BOS is simply a break above a previous higher high in an uptrend, or a break below a lower low in a downtrend. The second component is a fair value gap right after the supply or demand area. This can greatly enhance the strength of your trades. One of the primary factors you must seek when spotting a supply or demand area is an imbalance. And this occurs when an order block generates such strong trading volume in the market that it disrupts the balance between buyers and sellers, resulting in a gap. This is called an imbalance or inefficient price action. These gaps act like a magnet for the price to retreat to, aiming to correct the disruption in the market balance. For a fair value gap to form, there should be a sequence of 3 candles showing significant buying or selling, ideally in the same direction. When there's a substantial price movement either up or down, a gap emerges between the wick of the first candle and the wick of the last candle. Now, very important, we are not directly trading the imbalance zone itself. This is one of the most common mistakes. If you would trade all the fair value gaps you see on the chart, you'll end up with 50 trades in a single day. The key is to use the fair value gaps to enhance your decision-making process, but only when aiming for a supply or demand entry. A supply or demand area that triggered such a significant disruption in price becomes a more reliable entry point. And regarding this imbalance or inefficiency zone, it's uncertain when they will be filled, but history shows they eventually do get filled when conditions are favorable. And this is precisely why you don't solely rely on them for trading. Instead, you consider them a valuable confluence tool to have in your toolkit while analyzing a market. The third condition is a pivot point confluence. These are price levels used by institutional traders as significant levels in the market. These levels are calculated as an average of prices from the performance of the market in the prior trading period. As price gets into a pivot point area, whether it's the pivot or an S1 or R1 level, it will act as a support or resistance based on where the price has come from, meaning that if the price comes from beneath one of the levels, it will be held as a resistance point. Not a guarantee, however, but you are expecting to see a stall at that level. If the price comes into one of those levels from above, then you expect to see the pivot area act as support. Remember, it's not enough to find a pivot point and think this is support or this is resistance, so let me get long or short here. You want to find a key pivot next to a supply or demand zone, next to a fair value gap. I know ICT traders don't use pivots, but I consider them one of the best confirmation tools you can have on your charts. Fourth and final condition, a liquidity run must trap traders on the opposite side of your possible trade. So if you find a demand area leading to a break of structure, a fair value gap next to it, and a pivot point around the same area, if you find some sort of liquidity run, you're in a strong position to open a buy trade. Market liquidity is an overlooked topic when it comes to trading. Every time you open a trade, you are adding liquidity into the market, and you're probably familiar with the terms stop hunts or fakeouts. These terms describe a situation where a trader's stop loss is triggered, and shortly after this loss, the price moves in the direction the trader initially anticipated. This inexplicable situation arises because institutional investors need liquidity in the market to execute their significant trades. These movements are the primary reason why traditional retail trading methods like relying on trend lines or chart patterns like flags and wedges tend to be less effective. If a large percentage of retail traders are using these methods and place their stops around the same obvious levels, It's only logical that institutional algorithms would be programmed to exploit the stop losses clustered around these chart patterns. Many times, you correctly predict the direction in which the price will move, but just before the actual movement, the price intentionally triggers both buy and sell orders to gather liquidity from the market. This process aims to clear out these orders before the real move occurs. So you correctly anticipated the next move, but you somehow lost money in the process. So, developing the ability to identify areas where liquidity might be concentrated is crucial. We are looking at the 5-minute time frame of S&P, chasing a potential buy trade. First condition is met. A demand zone causes a break of structure or a change of character. In this example, this demand zone represents the area where buyers are likely to step in, causing a potential future reversal or a change in price direction. Condition number 2. Following the demand zone, you notice that there is a fair value gap on its right. This gap indicates a sudden shift in price from the demand area, suggesting that buyers have aggressively entered the market. Condition number 3 is also met. A pivot point offers additional confluence. You can observe that S1 pivot point aligns with the demand zone below the fair value gap, and this price level can act as future support, an additional layer of confluence, reinforcing the potential bullish bias indicated by the demand zone and the fair value gap. Condition number 4 is also present. A liquidity run traps sellers on the opposite side. As the price moves lower towards the demand zone and the pivot point, it triggers a liquidity run, trapping sellers who had taken short positions in anticipation of a downward move. The liquidity run results in a quick upward spike, further validating the bullish momentum. As all conditions in our trading plan are met, you place a limit order or enter directly at the top of the demand zone. You place a protective stop loss slightly below the zone, and your target profit is at the next major supply level, or at a recent swing high, or even at a pivot point. And this is the 5-minute time frame, so the stop loss shouldn't be too wide, and in most cases, you'll get a decent risk-reward ratio on your trades. We are analyzing the 5-minute time frame of US dollar versus the Canadian dollar, looking for a potential sell trade. Step number 1. We found the supply zone, which caused a break of structure or a change of character. This is the zone where sellers are likely to step in, potentially leading to a reversal or a change in market's direction if price returns to it. You mark the last bullish candle before the drop, or the cluster of candlesticks where selling pressure has historically emerged. Step number 2. Following the supply zone, you notice that there is a fair value gap on the chart, a sudden shift in price, suggesting that sellers are actively entering the market. Third step, a pivot point offers additional confluence. In this case, R1 pivot aligns with the supply zone, another resistance level. In this scenario, the pivot point adds an extra layer of confluence, reinforcing the potential bearish bias indicated by the supply zone and the fair value gap. And step number 4, a liquidity run traps buyers on the opposite side. As the price moves higher towards the supply zone and the pivot point, it triggers a liquidity run. Price experiences an upward surge, forms a double top, and takes the liquidity, temporarily trapping traders who had taken long positions in anticipation of an upward move. Combined with the supply zone rejection, the liquidity run results in a sudden decline in price, further validating the bearish momentum. As I said, you may not see the liquidity run on every setup, but it's a valid condition to have. You sell at the bottom of the supply level, and you place a protective stop loss slightly above the zone, and your target profit is at the next major demand level, or at a recent swing low, or at the pivot point. And here's another short position. First, we pinpoint a supply zone on the NAS 100 chart, indicating a trend continuation and at the same time a break of structure. Right after the supply zone, you notice a fair value gap, signaling strong selling interest and a significant influx of sellers. S1 pivot point aligns with the supply zone above the fair value gap, acting as an additional resistance level and reinforcing the bearish bias. As the price goes up, it even triggers a liquidity run, taking stops above this level. The sudden drop in price also traps buyers who were positioned for an upward move. Considering these elements, you can make the decision to enter a sell trade, anticipating the continuation of the bearish momentum generated by the supply zone, the fair value gap, the pivot point, and the liquidity run. 4 factors indicating the same thing. So you sell at the bottom of the supply zone. You place the stop loss slightly above the area, and you take profits as price nears the next major demand level on its way down, or at the recent low, or at the pivot point. Here's how a buy trade on Apple would unfold. First, we mark this demand zone, indicating a potential trend continuation. If we look at the past price action, we see the market making higher highs and higher lows. And we have this minor break of structure right here. Right after the demand zone, notice this fair value gap, indicating strong buying interest and an aggressive influx of buyers. S1 pivot point aligns with the demand zone, acting as an additional support level and enhancing the bullish bias. And in this example, we don't have a liquidity run, but this doesn't invalidate the setup. Considering these factors, you can decide to enter a buy trade, anticipating a continuation of the bullish momentum generated by the demand zone, the fair value gap, and the S1 pivot point. You buy at the top of the demand level, and the stop loss slightly below the zone, and your profit is at the next major supply level, or at the recent swing high, or at the pivot point. If you prefer swing trading, that's not a problem. This is USD JPY on the 4-hour time frame. The only difference is that instead of using daily pivots, we'll change it to weekly pivots. And you might want to reduce your lot size because the stops will be bigger. So condition number 1. The demand zone causes a break of structure in the market. This one is obvious. We mark it from the last bearish candle before the up move. And this becomes a special spot on the chart where the price might change direction, a potential U-turn zone where buyers might start to take control, making the price go up. Condition number 2. Do we have a fair value gap after the demand area? Yes, we have. Right after this demand zone, there's a gap in price, even multiple fair value gaps. It's a sign that lots of traders suddenly wanted to buy, which pushed the price higher. Condition number 3. Do we have a weekly pivot point that gives this area an extra power? Yes, notice that S1 pivot point is very close to this demand zone and the fair value gap. And that's our extra layer of support. It helps the price not decrease too much. Condition number 4. Do we have trapped traders with a liquidity run? I believe we have. At this minor break of structure. This is a liquidity run. It traps sellers who were betting on the market to go down. I would take this buy trade every time I'll see it. The entry can also be adjusted. You can use a limit order at the top of the demand area, but you can also refine it even more by moving on a lower time frame and finding some sort of confirmation. Now, you will encounter losing trades, even when all 4 conditions are met. The most important part of this trading approach is finding the right supply or demand or order blocks to trade. To efficiently plot supply and demand zones on your chart, you need to carefully consider a few key variables. First is the freshness. The strongest entry points occur when price retracts to a supply or demand zone for the first time after its creation. This indicates a fresh zone that hasn't been revisited yet. Time spent at the zone also matters. Less time spent there suggests a higher degree of supply and demand imbalance, meaning that significant market players are actively trading at that level. The distance moved away from the level matters, and we consider that in our analysis by looking for break of structure or change of character. Areas where price sharply turned around indicate high probability levels. Also, try to focus on the most recent supply and demand zones. This is a trade I lost taking a buy position on the 4-hour time frame. And I've lost quite a few trades before using the same principle until I realized this. A lot of traders focus too much on older levels, but the real power lies in the newest levels. I used to believe that old supply and demand zones are just as likely to cause price reversals as new ones. I thought that old zones work just as well as new ones without any difference. And when you look at the charts, it might seem true. You'll see old zones making prices reverse quite often. If you check charts from weeks or months ago, you'll find old zones that made prices turn around. But let's consider how supply and demand zones form. Banks create supply and demand zones by taking trades or cashing in their profits. They lead prices back to these zones because they haven't finished making all their trades or taking their profits yet. But here's the thing, why would they wait for months to do this? If they've already made a bunch of trades to push prices up, why not finish the rest of their orders sooner? To me, it doesn't make sense that banks would wait so long for prices to return to a zone just for a few remaining trades. If they want to finish their trades or take their profits, they would bring prices back to a zone quickly. They wouldn't wait around for weeks or months. They would do it right away. So very important, the time factor is going to have a huge impact. In this case, the zone was created at the end of May, and I was taking a signal in August. Banks already moved on, took their profits, and I was monitoring a useless area. So remember, the newer a supply or demand zone is, the higher the chance that the same kind of trading activity is still happening, or new traders will respond to it more actively. Now I want to showcase a type of trade you will encounter quite often. We are looking at the 4-hour time frame of EUR/JPY. Step number 1. A supply zone leads to a change of character. And this becomes our value area, where the price might change its direction, where sellers took control and made the price go down. Right after this supply zone, we spot a fair value gap in the price, a sign that lots of people suddenly wanted to sell, pushing the price lower. We also see that R1 pivot point is located close to the supply zone, above the fair value gap. This is our resistance level that could stop the price from going up. I don't see a liquidity run, so this isn't an A+ setup. Now here's the thing, if you placed a sell order at the bottom of the supply zone and the stop loss above it, you would have probably lost the trade. And this will happen a lot because we are dealing with leading signals. We are trying to anticipate future price movements, and this comes with such risk. If you don't like to set limit orders around order blocks, being on a higher time frame, you could move to a lower time frame, maybe the 15-minute chart, and wait for a confirmation. Maybe a change of character to the downside. Maybe you find another fair value gap to initiate a short position. You wait for a VWAP breakout to the downside, or even something else. With this lower time frame confirmation approach, you would have avoided the loss. But anyway, don't get too obsessed with eliminating losses. If your risk management is on point, there's nothing to worry about in the long term.